And welcome to ETF Edge, your go-to place for everything ETF. I'm your host, Bob Pisani. We have three of the very best people in the business joining us. We always have this. That's what you get here with ETF Edge. Doug Yones is the head of exchange-traded products over at the New York Stock Exchange. Todd Rosenbluth is the senior director of ETF and mutual fund research at CFRA. And Sal Bruno is the CIO of IndexIQ. Gentlemen, thanks very much for joining us. Doug, I want to start with you. I wonder if you could update us on the state of the ETF business. You do a quarterly report on the ETF business. This only goes through the first quarter of this year through March, but some impressive numbers. We still have 2,300 ETFs in the United States. I'm quoting from Doug's report, folks. Assets under management, $3.7 billion. We're close to $4 billion. Doug, give us a little update on where we're at. I know there's been a little bit fewer ETFs in the last few months. Some funds have closed, but overall, I still see on net continued inflows and continued high interest in ETFs.
Yeah, it's been a very active market, Bob, and that, I don't just mean volatility. With respect to new products launching, we've had 87 ETFs launch year to date. Net cash flow for the year, close to $188 billion in ETFs. So even with the significant market swings, it's been a positive year. New asset managers entering the space, like BNY Mellon is a new asset manager. We're expecting Allianz to enter in the next few weeks. So with over $4 trillion right now sitting in the U.S. ETF market, there's still a lot of greenfield opportunity for new managers to come in. And regardless of a volatile market, the reality is that ETFs have performed exceedingly well. In fact, they've brought in net cash flow every single month. So even in the midst of the sell-off in March, we saw equity ETFs bring in probably about close to $18 billion that month. So ETF investors certainly wholehearted and certainly still active regardless of market conditions.
And this is why we continue to see new entrants into the market, like BNY Mellon and Allianz. People a couple of years ago said, oh, everything's been invented. It's like physics 100 years ago. We've invented everything. What else can you do? And it turns out, even if you have a product that's essentially the same thing, Schwab proved this very definitively, I think, a few years ago. They have an active base of investors in their own camp. Why let somebody like a Vanguard or an iShares capture that when you could essentially do the same thing? So I certainly think, Doug, it's very smart. I wonder if you could update us on this whole ANT product, active non-transparent ETFs. This was a hot thing in the beginning of the year. And even though a few firms have started doing it, creating ETFs that are actively managed parallels to their mutual funds, I don't think it's caught on in any big way. Can you give us 20 or 30 seconds on where we're at on that? Because it was a hot topic a few months ago.
Yeah, I know we're pretty early in 2020, but I will say this could be the year of active. And what I mean by that, over half of the ETF launches year to date have been actively managed ETFs. Now, the reality is the majority of those products are still showing their holdings every day. As you mentioned, though, we have two products year to date that have launched in this semi-transparent structure. They do a quarterly holdings release, and about half of the models are now approved. So active managers that are thinking about coming to the space but don't want to show their holdings every day, we're really engaged now with a lot of conversation about bringing those products to market. The reality is active is performing. We're seeing net cash flow into those products, even just looking year over year. At actively managed ETFs, about a 36% increase in assets under management. So for those investors that are looking for an active structure, they do seem to want to access that in an ETF wrapper. And for the issuer of active management, the ETF wrapper offers a lot of benefits. They tend to be lower cost and they offer global distribution. So there's a lot of reasons on both sides of the fence why an active manager or investors want to be involved with an ETF wrapper.
Okay, Todd and Sal, let me bring you two in on this. Just a quick comment from you. I know, Todd, you're a very active observer of this whole space. We're approaching the half-year mark, and what's amazing to me is, despite all of the volatility, number one, ETF products have held up very well. Yes, we had a very specific issue around the oil ETF that had to do with the fact that you're owning futures products, and this is a very separate part of the whole ETP space. I want to separate that a little out. I'm talking about the equity products out there, even the leverage and inverse ETFs. What struck me is they all held up remarkably well. And I wonder if you could quickly comment on that and what it tells us Secondly, on the corporate bond space, tremendous stress in that area. We did have some differences in the net asset values there and the prices of the ETFs. But even here, it seems like the ETFs are on the right side of things. Just give us a brief overview of where we're at here, Todd.
Yeah, Bob. So what we've seen is that investors actually flocked to ETFs during the market volatility that we covered earlier. Doug talked about at the end of the first quarter. And we've actually seen money flowing back in to fixed income ETFs. They've actually been the more popular product, whereas we've seen outflows in the past month to S&P 500 index-based products like SPY, IVV, and the VU. It's rare to see those three ETFs together see outflows when the market's been up. But it's been high yield. It's been investment grade products that held up exactly as they should have during the market volatility. And now with the Federal Reserve looking to get into this space, or actually having ETFs to get stability, we've seen investors going into that. Real quickly, if I could, we're seeing active ETFs actually in the transparent way in the second quarter that Doug talked about. So JP Morgan entered with active equity ETFs about a week ago, and we've seen smaller firms like TrueMark actively manage ESG products. So we are starting to see firms, including Sal's firm, that are offering actively managed ETFs.
Okay.
Yeah, Bob,
and we're getting a little crackling. We're getting a little crackling in your microphone there, in your sound system there. So we'll see if we can improve on that. Sal, did you want to step in here?
Yeah, I was going to just jump in with a quick point. I think it's interesting that ETFs have taken in assets, and we've seen flow and a lot of trading volume. It's easy to remember because it seems like time it's just going amazingly quickly. But it's only been 8 or 9 months ago that we go back to October, and we actually saw all the TD Ameritrade, Schwab, E-Trade, and others drop trading commissions down to zero. And I think that was actually a really interesting development that we lose sight of. So for investors in this point in time in the market and seeing the volatility and trying to react nimbly, you removed all the transaction costs. Of course, you saw the bid-ask spread and market impact potentially. But in terms of hard costs, those went away. So I think it enabled investors to move even more quickly throughout these more volatile times into and out of ETFs. And then they're trying to trade, equities and trying to position themselves well. So I think that's kind of an interesting observation of point.
Do you think that the fact that we went to zero commissions on stock trading and many ETFs encouraged more active trading, Sal?
I think it not necessarily encouraged it, but enabled it. And I think investors were looking in this volatile period where you saw, stocks fall from the February highs right around President's Day to late March where they bottomed and then came back. I think people who were looking to be nimble found that they did not have to worry about transaction costs as an impediment. So I wouldn't say it encouraged it, but it definitely enabled it.
Yeah, I'll add to that.
Doug, what do you think?
I think
Doug, what do you think of this?
Good point. The reality is
sorry.
Individual investors, hedge funds, all the way through institutions, insurance companies, when the markets were swinging so volatile, right, day over day, we were seeing them really engage with ETFs. And, the fixed income was a very good spot to really highlight because we've had over $55 billion in net cash flow in fixed income ETFs year to date. But we saw ETFs trade the way the fixed income markets were trading. When there was a sell-off in fixed income, we saw sell-offs in ETFs. And those ETFs provided a bit of a buffer for the underlying securities. And I think that's one of the pieces that the market gurus get into. But individual investors, if you want to tap into, let's say, high-yield bonds or muni bonds, it can be very difficult in times of stress to trade the underlying bond. Yet individual investors on some of those platforms with zero commissions had the ability to go in and trade, whether it be they wanted to own more exposure or reduce their exposure. They could do so through ETFs with zero commission at a time when the underlying bonds were struggling to trade.
Yeah, I think the whole thing that happened with the bonds, with the LQD trading at times premium, times a discount to net asset values, exonerated ETFs. We saw this with Chinese ETFs earlier in the year where the China market was closed and the ETFs here in the United States traded perfectly well and very accurately reflected ultimately where the pricing was going. So I'm hopeful that this will accelerate electronic trading of bonds or whatever we can do to get quicker, more accurate bond prices.